What's up, guys? This is Manoj Vaptani. I welcome you all on behalf of the Wikipedia world. It's been an amazing morning outside, and I'm sure that you guys must be enjoying your life to the fullest, guys. Superb. So, how's your life going on? How has been your preparation with altogether CA final examination? Not just about SFM. Like there are other subjects as well on which you need to work out. You need to study continuously. You need to ensure that you do give your proper timeline to each one of your subject. Are you really keeping yourself updated with all the kind of amendments which are going ahead in the market as far as your examination point of view is concerned? I'm sure, guys, you must be taking very good care about your CA final examination, and certainly you must be working really hard. So, we all, on behalf of the Wikipedia world, we would just like you to uh, appreciate and acknowledge the kind of efforts that you are going through as of now. So keep them intact, keep them for a longer period of time, for the entire duration, for almost by the time you are just not able to sail through your CA final examinations. Keep that enthusiasm intact and keep that enthusiasm in your body, mind, and soul all the way, because that is something which is extremely important and imperative for all of you guys. So, guys, this is going to be the sixth video presentation in which I'm again going to discuss a few of the more relevant questions which have already been asked in C final examination with respect to the topic of derivatives. So, are we guys all set? And are we guys revising our topics thoroughly? Remember, guys, whatever the kind of stuff that I'm doing with you, whatever the kind of efforts that Edupedia World is making out for you, everything is gonna be going in vain if in case you do not retain your topics. Trust me for this thing, guys. That is something which is extremely important for you. So don't skip your revision. That is the one and the only thing which I always ensure you before I start my any of the videos, because I know the importance of this one thing in my life, that revision is the key to failure examinations. There is no other way with which you can completely be sure of that yes, you will be able to clear your examination. That is only revision which makes you feel empowered, which makes you feel confident about the kind of subject you are dwelling your hands into. The only thing that is going to ensure that you guys don't flunk in your C final examination is none other than your revisions. So do not skip on that. So let's mark the beginning with the first question of the day of this wonderful presentation. I hope and I'm sure you guys are going to be liking it ahead. So it says this question was asked in CA final examination for June 2009. It says the shares of X Limited is currently selling for rupees 300. The risk-free interest rate is 0.8% per month. Okay guys, per month, not per annum. A 3-month future contract is selling for rupees 312. Develop an arbitrage strategy and show what your risk less profit will be 3 months down the line, hence assuming that X Limited will not pay any dividend in the next 3 months. Clearly a very basic question. Then why have I introduced this particular question in this particular presentation? There is a reason behind it. It's a very simple stuff which says there is a share of one company which is traded in the exchange and it is currently selling for rupees 300. The risk-free interest rate on that particular stuff is 0.8% per month. In order to achieve the interest rate for the next 3 months, all you need to do is just multiply 0.8% with 3 and you'll get the interest rate, risk-free interest rate for a period of 3 months. Simple, guys. And it again says that the 3-month future contract will be selling out in the market for rupees 312. Now, what should be your arbitrage strategy? Okay, the thing is very clear, guys. Go and buy your exchange, your stock of X Limited, currently which is trading out in the market at 300. Just go and buy the same from the market at rupees 300. Simple. For that particular stuff, I'm assuming that you won't be having 300 rupees in your pocket. So all you need to do is just buy the same by paying the interest. Simple. You'll have to pay the interest at a rate of 0.8% per month for next 3 months, which comes out to be 2.4%. All you need to do is just borrow this 300 at 2.4% interest rate from the market for 3 months and go and invest the same by buying it from the market for rupees 300. Simple, cool. Now, after a period of time, which is the 3 months, your interest that you would have been like likely to be paying back to the market, that would be like costing you some 7 rupees something on behalf of that 2.4%. Exact calculation will be 7.2. Okay, so you bought something for 300. For that particular thing, you had to shed out of your pocket 7.2 rupees. Okay, and at the end of the day, you can sell it in your future contract for rupees 312. Isn't that cool enough? It's perfect, right? You just go into the market, you buy something for a lesser, cheaper price, get the interest thing fixed, and sell it at a profit. That is way simple. Okay, so your net payout in this scenario would be 4.8. 312 minus 307.2. Your net arbitrage, the gain that you made out of this particular transaction will be 4.8. Simple, guys. This is one way to look out at this particular question. Okay. Now, coming to why I have incorporated this particular segment in order to make you analyze another thing. Okay. This particular question is nowhere asking you up that if you are buying your share into the market, you cannot deliver the same into the future. There is a very good thing which is going on to the market which says that mostly the future contracts are settled by way of a differential. But that is just not the case, because as far as this particular question is concerned, you just need to erase that particular knowledge from your mind. Okay, here in this particular question, you are comparing two different things out of two different markets. At one point, you are telling a person to buy your stock from the normal market, which is the normal stock market. Okay. And at the same time, you are again asking a person that the 3 month future contract, which is usually settled only on the differential price, futures normal practice which goes into the market is future doesn't allow you to go for a delivery option. You don't get the delivery done. Okay, usually you don't get the stocks in your pocket. All you need to do is you just fix out a future price that yes, today I am entering into a future contract for, let's say, Reliance share for rupees 300. After a period of time, 3 months, that 300 becomes 350. You make a gain of 50 rupees per contract on a basis of that lot size, and then you just take out that 50 rupees in your pocket and you just leave. You're not concerned with the delivery terms at all. But in this particular case, since it is asking us to compare two different things in two different markets, we are assuming that the future contract will allow us to provide this particular contract. And how is it feasible? Is it really feasible to do it? It's absolutely not. So what we need to do is we just need to arrange for in the presentation a certain method with which we can derive onto this particular conclusion that yes, we have actually made up a profit of 4.2. And how we can do it, just let's see the solution. The fair price of X Limited 3 month future will be spot, which is 300 rupees. You just need to add the carrying cost. Whatever stuff that I made you understand with my example, that was none other than the carrying cost. What is the amount of interest that you need to pay? That is 300 multiplied by 3 into 0.008. Difference, deduct dividend, any form of dividend that you'll be getting in your pocket by holding that particular stock will also be deducted. Why? Because that is something which will be reducing your cost. Okay, you don't have to pay for it. There is something, a kind of additional gain. So we are basically analyzing this particular equation with a kind of mindset that what is the actual cost that I need to incur out of my pocket in order to acquire that stock price. Simple, guys. 300 I had to pay on that particular stuff. I had to arrange a fund basically. So I'll have to pay the interest on it, which is 300 multiplied by 3 into 0.08. Deduct 0 out of it because in this question there is no dividend. So my overall fair price of X Limited, which should be there after a period of 3 months, it should be 307. But the market is providing me this particular stock after a period of 3 months for rupees 312. So what do I need to do? Therefore, today I as an arbitrator I would buy this stock for 3 months, okay, and I would sell this 3 month future. Simple. By doing it, I would encash the riskless profits today, and after 3 months, the offsetting deals would cancel it. Now, what do I mean by offsetting deals? Guys, I need to add on to do basic things today, okay, in order to ensure that my this transaction gets settled. Okay, what do two different things are? What these two different things are basically are? Activity that I need to get involved in today is basically I need to sell a future. Okay, I will be telling to the I will be going into the market and telling them that yes, I want to sell out a future which is available in the market for rupees 312. I'll do it today. Okay, and at the same time I'm gonna buy in this spot market. I'll just go into the spot market and I'll ask the person to sell me a particular stock of X Limited, and they can provide me that particular stock for rupees 300. So I have already entered into a future contract for selling which is at rupees 312, and at the same time I'm buying a stock for rupees 300. Simple, fair enough. So what activity do I have to dwell in once it comes to an expiry period? Since I've already entered today in the selling of the future contract, at the expiry I have to buy it because in order to squaring off of the position. So I'll buy it. I'll see that this is basically called FT. This is basically none other than the FT. Okay. And at the same time, since I've acquired today a particular stock for rupees 300, I have to sell it at the expiry in order to again square off the position. I'll say selling of the stock, which is ST. Future FT, selling of the stock is ST. Okay. So what do my net position will be in this particular case? I'm selling something in future market for 312. I bought something for rupees FT. So what will be my differential? It will be none other than 312 minus FT. I'm presuming it may be like 300, it can be 305 FT, it can be 310, anything. Let's assume it. Okay. At the same point of time, I am buying a stock into the market today at 300 rupees and I'm selling that particular stock in the expiry time at cost ST. Okay, so again my differential will be ST minus 300. Again I'll get something. What was my funding cost? That is none other than 7.2, which I made you understand. One stock purchase was able to be done at a cost by incurring the cost of 7.2 rupees. So again, what would have been my net gain at the expiry? I'm assuming that this particular transaction will be entered upon only and only wherein we have been like finding out that ST would converge with FT and at the expiry they would just cancel out. Again, I bought something in the stock market, that is spot market, regular cash market by buying a particular stock in consideration of the cash, and I just sold that particular in the future market for rupees 312. So by taking care of both these transactions, I just simply come to a conclusion again back, which is the net gain at expiry will be none other than 4.8. But then why I incorporated this particular thing in my presentation? In order to make you understand that guys, both these transactions can never be fulfilled unless we keep the activity at expiry, which is buying of the future and selling of the stock in order to square off the position. Otherwise this cannot be feasible. So we'll have to square off the position, only then we'll be able to take care of this particular arbitrage gain, which is essentially available to us in two different markets. In order to tap the opportunity in two different markets, we'll have to get involved in simultaneous vice versa contracts as well. That is what I wanted to tell you guys. I hope you guys got the complete clarity about this particular question and why it looks very simple, but then it is expected out of us that in the examination we are also supposed to present this particular perspective as well. No matter, yes, you'll be providing them the solution only by 312 minus 307.20 and by fetching them the gain and reflecting the same in your paper by 4.8. Uh, I'm not saying you won't be getting the marks. Definitely you will get the marks, but the chances of getting the complete marks will remain. The hope will be like just not be like complete with that particular scenario. So you'll have to incorporate this particular thing in your presentation. Clear, guys? Superb. Let's move ahead with the second question. This question was asked in CE final examination, which says which position on the future index gives a speculator a complete hedge against the following transactions. Number one, the share of right limited is going to rise. This particular speculator is of the opinion that the share of right limited is a company over here, the share price of right limited is going to be rising into the market. Okay, he is speculating it. Okay, and he has actually got into a transaction which is he has shortened his position on the cash market. Okay, for rupees 50 lakh on the right limited. Now the beta of right limited is 1.25. I'll be completing all these three different scenarios one by one. Okay, let's complete this one first, and we'll move ahead on the second one. Here and guys, it's been told that the speculator is basically expecting the share of the rise limited is going to be like rising after a certain point of time, and he has actually shortened his position. He has actually sold his shares into the cash market for rupees 50 lakh. Okay, now at the same point of time it is being told to us that the beta of right limited is 1.25. Okay, now what do he has to do in order to ensure that he doesn't suffer losses? What all steps do he need to take as far as his positioning in the future market is concerned? Guys, there is a very basic thing about beta. I just want to tell you, and I would just want to reiterate what do beta mean basically, in order to ensure that you guys get the complete clarity about this particular aspect. Guys, beta is something which is based on the risk factor. Okay, it is basically a kind of a valuation. Okay, I'll better say it's a valuation which compares one company's risk with the market and different scenarios with the overall economy's different securities ones. Okay, let's suppose if I'm telling you that the beta of right limited is 1.25 and the market's major securities or the benchmark securities are having a beta of 1. I simply mean by this term is that the right limited's share is riskier than the market's share by 1.25 times. It's as simple as that. If I'm telling you that I will be suffering 5 rupees loss if in case I will be investing into the market, then at the same time my overall loss if in case I am investing in the right limited, that will be amounting to 5 into 1.25. Simple guys, very simple basic example. If I'm expecting that if I would have invested my money into the market, I would have been like losing out an amount of 500 rupees just because of the fact I know that right limited's share is 1.25 times riskier. So I simply understand this thing that I would be able to I would have been into a position wherein I would have been incurring a loss of 500 multiplied by 1.25. Had it been the case, I would have invested my money in right limited. And that's what beta's job is all about. Beta is something which provides you a kind of risk factor in comparison with the normal market. So, since here it's being told and quoted to us that the beta of right limited is 1.25, I can simply understand this thing that if in case my cash market position has been shortened by 50 lakh rupees, and if any mishap happens to my money with respect to rise limited, I can simply say that if it would have been like I would have been getting into the loss of rupees 1 into the spot market, I would be getting a loss of 1.25 into the future market. So what do I need to do? Since I have shortened my position in the cash market for 50 lakh rupees on right limited, and I'm expecting that the future in the coming future, the price of the rise limited is going to be rising. In order to offset my position and ensure that I don't suffer any kind of losses, since I've shortened my position here, I'll have to buy it into the future market. So at what amount should I buy this particular security? That is none other than 50 lakhs multiplied by 1.25. Why? Because my security of right limited is 1.525 times riskier than the normal market. So in order to hedge my position, I'll have to get 50 lakh multiplied by 1.25, which comes out to be around 62.5 lakh rupees. Clear guys, this is what I need to do if in case I'm a speculator and I want a complete hedge against all these transactions. Number two transactions comes in, which is the share of wrong limited is going to be depreciate. Okay, he has again a short position in the cash market for rupees 25 lakh for wrong limited. The beta of wrong limited here is 0.9. Now again, this person has shortened his position into the cash market, which is he has sold his shares of Wrong Limited into the cash market for rupees 25 lakh. Now the beta of Wrong Limited is 0.9. It is not even 1. So I can simply say that the market securities are more riskier than the Wrong Limited. So what do I need to do in order to protect myself? I just need to invest some amount of money into the future market, which is less than what I am receiving from the cash market, because my security is a bit less riskier. So I will be investing 25 lakh multiplied by 0.9, which comes up to be 22.5 lakh into the future market, and I'll be buying the futures over there. Simple, guys. Lastly, the shares of Fair Limited is going to stagnate. He has a short position on the future on the cash market for 20 lakh for Fair Limited. Again, short position, which is they have sold their shares into the cash market for rupees 20 lakh for Fair Limited. Now the beta of Fair Limited is 0.75. Again, guys, this is something which is very interesting. I can simply say that the Fair Limited share is less riskier to invest than in comparison with the industry, which is the market. So again, I'm getting a very good position over here. I can just simply buy the futures at rupees 15 lakh. That is 20 lakh multiplied by 0.75, and I can hedge my position very well. Clear, guys? This question was asked in CA final examination. Now I am completely sure about this thing that yes, I have provided you the basic insights and the more or less complete insights about this particular question while discussing the question itself. Now let's just move towards the solution part in order to make sure that yes, you guys get the complete clarity. So hedging is basically a taking of an equal and opposite position in another market. You're just saving yourself while you have already committed something in one market. You are saving yourself by entering into another market for the same position on a vice versa note. Simple. So which is an equal and opposite position, so that the loss that may arise in one market would be compensated by a gain in another market. The extent of hedging, which is the hedge ratio, it is basically determined by a beta of security, which I just made you understand, guys. If the beta is greater than 1, then the hedge ratio is greater than 1. Then the position hedged will be higher than the underlying position. Clear, guys? Now you're getting why I was telling you this thing, that yes, I just need to ensure that I buy more as compared to what the same will be delivered in the market, because my beta was higher in case of right limited, that is 1.25, and would be proportionate to the beta of security. So in this case, which is the first one, right limited, the speculator will hedge by selling in the future market, which is equivalent to 1.25 multiplied by 50 lakh rupees, which comes out to be 62.5 lakh. Next comes in this case, which is the case of Wrong Limited, the speculator will hedge by buying the securities at a future market, which is equivalent to 0.9 multiplied by 25 lakh, which comes out to be 22.5 lakh. Clear, guys? And lastly, in this case, the speculator may remain unhedged because it is being told that the market is going to be stable. One thing is the speculator may remain unhedged. He might not enter into another transaction because it is he is expecting the market to remain stable. But it's still recommended that yes, one should go for hedging in order to ensure that he can protect himself by buying something into the future market. So hedging by buying into the future market of equivalent of rupees 0.75 multiplied by 20 lakh rupees, it comes out to 15 lakh. That would protect him from unanticipated losses. Now, I would just like to apologize you guys for point number A. Herein, I have just mentioned in this case that the speculator will hedge by selling in the future market. No, he should be buying into the future market. Why? Because he has already shortened his position as far as the point number A is concerned. He has already shortened his position in the cash market. So now he just need to make a opposite position in the another market, which is buying. So herein there is a typographical error. Kindly excuse me for that. Thank you so much. Now let's move ahead with the next question, which has again appeared in one of the C final examinations, and it says, and trust me, guys, just keep yourself intact with this particular question. It's a very, very, very fantastic question, and this question has got a good kind of possibility to create confusion. So I'm just making you aware of this thing. Keep yourself intact and keep your attention here itself. So it says BSE index. Today the BSE index price is rupees 5,000. At the same point of time, he's also mentioning us that the value of the portfolio that you'll be entering into is priced at rupees 10 lakh 10,000. The risk-free interest rate is 9% per annum. The dividend yield on interest is 6% per annum, and the beta of the portfolio is 1.5 times. We assume that a future contract on the BSE index with 4 months maturity is used to hedge the value of a portfolio over the next 3 months. I'll again say, we assume that a future contract on the BSE index with 4 months maturity is used to hedge the value of portfolio over the next 3 months. Clear, guys? There is a difference. Cool. One futures contract is for delivery 50 times the index. That is a kind of lot size. Okay, one future contract is for the delivery of 50 times the index. Based on the above information, calculate the price of the future contract. Are we guys all set? Next thing is the gain on the short future position if the index turns out to be 4,500 in 3 months. Why I am basically making it a point that I am making a remind about the time period so well, because in this particular scenario you'll get to know, because it has been told to us that the future contract on the BSE index is basically for 4 months maturity. Okay, and the same, this 4-month maturity future contract is used to hedge the value of the portfolio over the next 3 months, just 3 months. Okay, so keep that in mind. Okay, there is gonna be a bit of tediousness with respect to the time period. Okay, now let's go ahead and understand first of all which comes out to be the price of the future contract. What should be the price of the future contract after a period of 4 months, because the contract is for 4 months maturity. Guys, the price of the future contract, the concept is very simple. All you need to do is just get the spot price, arrange the cost of your carrying value, which is the kind of interest that you will be bearing, or any other form of interest cost that you will be bearing in order to obtain that stock or maybe index. Okay, so spot index plus cost of carry minus any form of dividends that you'll be receiving, so that is something which will be deducted out of your costs. So the basic thing is very clear over here, which comes out to be FT is equal to ST, that is your spot price, multiply the same with 1 plus the cost of carry. Herein that will be for the month, for basically 4 months. Deduct any form of dividend, and here also that will be only for 4 months and not for complete year. So today's spot price in the market is 5,000 rupees. Clear, guys? Yes. Add to it any form of dividend, any form of risk-free interest that you are paying back to the market in order to acquire that 5,000 rupees index position. So the risk-free interest rate which is available into the market is 0.09. Okay, that is for complete year. In our case, only 4-month applicability is concerned. So multiply 0.09 with 4 by 12. Deduct any form of dividend that you have received, which is 0.06 in this particular case, and that too for 4 months only. Multiply the same with 4 divided by 12. Simple. So you get a figure of 5,000 multiplied by 1. 1 is basically in this particular scenario, that is a common stuff that has to be incorporated while adding the risk-free interest rate and deducting the dividend. So 5,000 bracket multiply the same with 1 plus 0.09 divided multiplied by 4 by 12 minus 0.06 multiply the same with 4 by 12, and you will get a figure of 5,050 rupees. So the price of future contract, it would be 5,050 rupees. Today it is having the spot price in the market at 5,000. Future contract price would be 5,050 rupees after a period of 4 months. Clear, guys? Simple. Now this was a very basic part. Okay, the main confusion comes in, the main, I won't say the confusion, the more trickier part in this question would be the gain on the short position, short future position, if the index turns out to be 4,500 in the next 3 months. What would we do? Okay, Guys, in this particular scenario, it has been told to us that the index turns out to be 45,000 in 3 months. But the first part that you actually calculated was on the basis of how many months? Say it again. Cool. That was on 4 months, right? Now it is being told to us in the question itself that the index turns out to be 4,500 in the next 3 months. So I would basically say that what will be my benefit after a period of 1 month? Scenario will be like very simple. 45,000, 4,500 is a position of mine after 3 months. So what would be my position after 4 months? I'm expecting it has to grow in the future months to come, because the risk-free interest rate that I have to get in, I'll have to add the value of that particular risk-free interest in that 4,500, and I'll at the same time I'll have to also deduct the dividend yield that I'll be getting. So this 4,500 will be like definitely going up, because I have to add to my costing that 1 month interest deduct after deducting the dividend yield as well, so that I can compare the position with what I actually got in my first part, that is 5,050 rupees. In comparison, in on the same plate I can capture 45,000, 4,500 plus something something, which comes out to be for 4 months. So again, I'll have to get the parallel combination done, which has to be, I'll have to get both the figures for 4 month maturity. That is what the trickier part involved in this question is. Now, in order to hedge the portfolio using the above future contracts, the investor would sell the futures of beta times the portfolio value. I will make you understand this concept really clearly, guys. So just keep your mind intact. Don't go anywhere. Therefore, he would sell how much? Remember, guys, in my last question, I made you understand that beta is something which makes you understand that how riskier a company's share or stock is in comparison with the market or industry. Here in this particular scenario, it has been told to us that the beta is 1.5 times. So my portfolio size, the portfolio value which I invested in the market was 10 lakh 10,000. Okay. Now, since my beta of this particular scenario comes out to be 1.5 times, so my overall scenario is 1.5 times more riskier than the market. So if I would have invested 10 lakh 10,000 rupees in the market, what should be the amount that I should invest? Had it been the case, I would have to deal out with this beta of 1.5. That comes out to be 1.5 multiplied by 10 lakh 10,000. Clear, guys? Simple. I'll have to divide it with my future price, which comes out to be after a period of 4 months. Okay, because I am getting into the hedging part after a period of 4 months. Okay, not after a period of 4 months, for a period of 4 months. Okay, so it has to be 50,000, 5,050 rupees. Okay, multiply the same with the normal lot size, which was being told to us as 50 times. The one future contract is for the delivery 50 times the index, so multiply it with 50. Okay, now after doing it, you'll come to a conclusion that the overall contracts that you entered into the future market in order to hedge your position was 6 contracts. 1.5 multiplied by 10,000, 10 lakh 10,000, divide the same with 50 multiplied by 5,050, and you come to know that your contract's number would be 6. Now, it says after a period of time that if index turns out to be 4,500 after 3 months, what would be the future 1 month to expiry, and at what price it would be like priced? Simple, guys. 4,500 multiply the same with 1 plus 0.09, which was the risk-free interest, multiply it with 1 by 12, because you're already thorough with 3 months. All you are left with in order to ensure that you reach to a parallel position with 4 month maturity is 1 month. So 1 divided by 12, deduct 0.06, which is the dividend yield out of it, multiply it with 1.12 again for that 1 month. So your security future price will be like priced at 4,511.25 rupees after a period of 4 months. Now, this position is at par with 5,050, which is again at 4 month maturity. and this one, which is 4511.25, which is again at 4-month maturity. So what would be my complete gain in this particular scenario? That will be none other than 6 contracts total. Multiply the same with 50 units because it has a normal lot of basically delivery position is 50 times the price index. Multiply it with 50 units. Multiply the same with the differential, which is I'm expecting my future price to be 5,050 rupees, but if in case it falls down to 4,511 rupees and 25 paisa, what will be my gain in this particular scenario? This is something really cool. I I can basically I shorten my position into the future market for 5,050 rupees. Now the same uh, can be like only and only shortened at a price of 4,511.25. So I actually made an overall gain of 1,61,625 rupees. Simple guys. I shortened something for I sold something for rupees 5,000 rupees. Okay, and now I can sell it for only 4,500. So what is my scenario? I am basically gaining out on this particular transaction, and that's what this person has also did. Clear, guys? Now got to know why I was telling you this thing. It's a really cool question, and it is a tricky one. Okay, so you need to keep your minds awake while solving the same question in your examination. Okay, don't write down any of your presentation uh, while you are in haste. Okay, so keep steady with the pace and do ensure that you get the question very right. Okay, you get the kind of thing that the examiner is expecting out of you in a very right manner. Okay, only then you'll be able to clear your question. Sorted, guys. Super. Let's go ahead with the last question of this particular presentation. It says Ram buys 10,000 shares of X Limited at rupees 22 and obtains a complete hedge of shorting 400 Nifties at 1100 each. He closes out the position at a closing price of the next day, at which the point the share of X Limited has dropped by 2% and the Nifty future has dropped by 1.5%. What is his overall profit and loss on the set of this transaction? Simple scenario, guys, very basic stuff. Ram has actually bought something into the cash market as 10,000 shares for 22, and at the same time he has also sold those things in the Nifty market, that is the future market, uh, for 1,100 rupees each. And how many Nifties he has entered into? That is 400. Okay, now today's valuation is concerned, I have bought something for rupees 2.2 lakhs. 22 rupees multiplied by 10,000 shares, that comes out to be 2.2 lakh rupees. And at the same time I have sold something for 1,100 rupees each for 400 Nifties. My future shorting of value comes out to be 4.4 lakhs. Simple, guys. I made up a gain of 2.2 lakh here itself. Now, the thing is, he's not concerned about my today's valuation. Okay, he's basically concerned about the gain or loss that I made on the basis of next day's valuation. It says Mr. Ram just woke up tomorrow in the morning and got to know that the share price of the X Limited has dropped 2%. Now he will be like getting into the panic. Okay, he'll be like, oh fish, I bought something for a higher price. I should have waited for it tomorrow, and definitely I would have been able to attain that particular share at 98% and uh, not spending the 100% on it because the share has dropped by 2%. Now he is having this fair idea in his mind that he has got the next day's valuation for 21.56 rupees. Okay, if I'll be like dropping 2% out of 22, it comes out to be 21.56. Multiply the same with the number of shares, which comes out to be 10,000. So you get that the next day's valuation of what he purchased yesterday is 2.156 lakhs. It was earlier 2.2 lakhs. He has actually lost this particular on his valuation, which comes out to be 0.044 lakh rupees. Okay. Now, at the same time, he just smiles. He just says, wow, I just forgot one thing. What? He just forgot that he has actually ensured that he has hedged his position into the future market by entering into the Nifty future. So he has just sold his position over there, and Nifty future is also dropped by 1.5%. Now he'll be like very happy. He'll be like, wow, I'm so smart. I just made up a very good transaction in order to ensure that I don't loosen out onto any other opportunity. So now his Nifty future has also dropped by 1.5 times. So what thing which he entered into yesterday, that had a valuation of 4.4 lakhs. Now the same is having a valuation of 4.334 lakhs, because that 1100 has just fallen down by 1.5 time 1.5% to 1083.5. So now he has basically gained out of this transaction by selling the future earlier on the day and not on the next day. So his gain in this particular transaction will be 0.066 lakh rupees. So what is his net gain? 0.66 lakh minus 0.044 lakh. It comes out to be 0.022 lakhs, which comes out to be 2200 rupees. So this is what he has actually gained out of this transaction. I'm sure that you guys got the complete clarity as far as this question is also concerned. Wonderful, guys. So all you need to do is what? Remember, revise and retain. Whatever thing that I'm making you understand in this particular video presentation, I'm sure that you guys are getting thorough with all the segments. But then you just need to ensure that you guys don't skip on your revisions. To ensure that yes, you are revising your topics on timely intervals. Remember that. And if in case you have found this video informative, if in case you have found this video really useful, do not stop yourself from sharing it with your friends. Sharing is caring, guys. There are so many people available in our country who are definitely requiring some certain stuff like this, who cannot certainly afford education at nominal cost even. So here also we are basically encouraging our idea that we need to provide you guys the education free of cost, and that's what we are doing in. So do share this particular thing with your friends as well. I'll say thank you on behalf of the Edupedia world. Stay connected, guys. That will help us in understanding your needs way better, guys. And keep interacting with me wherever you get a chance. Okay, do write to me about the kind of stuffs, about the kind of videos that we are making for you guys. Whether you're really liking it, what all things do you find that we can change, and what all things do you really want and you really appreciate and acknowledge as far as our videos are concerned. So do write to us about all these things. That will help us to stay on our toes all the times, and definitely we will be able to provide you better quality services. Like, share, and subscribe to our videos. And with this note, I'll say this goodbye to you, and I'll see you in the next presentation with a lot more questions we are there available for you guys. So till then, stick around and just get better with your securities and your stuff. Wonderful, guys. God bless you all. Sayonara. Bye.